Hi, I'm Michael Davin from the Department of Accounting. Today I'm going to introduce you to the what and why of accounting. You probably think accounting is boring, that it's all about numbers, that accountants have to be good at maths, and that accounting requires memorising rules and procedures. Well, you would be wrong. In reality, accounting is about decisions and the information required to make effective decisions. Accounting requires judgment, interpretation, and an understanding of the meaning of accounting information to enable economic decision making. So you can share in my passion for accounting, let's focus on a shared passion of many: coffee. This is Barry the barista, owner and operator of a local coffee shop, Barry's Barista Bar, or BBB for short. Barry loves coffee. Establishing his own coffee shop was a dream fulfilled for Barry. Barry knows coffee. I mean, he really knows coffee. His double shot latte with a dollop of cream is heaven in a cup. But Barry doesn't understand accounting or why it matters. Today we're going to see how accounting can help Barry continue to enjoy his dream of running a successful coffee shop. Here is Barry doing what he loves, selling coffee. But for Barry to be able to keep doing this, we have to address some important questions. Did BBB make a profit on this sale? Is the value of his business growing, or is it doomed to fail? Accounting can help answer these questions and more. BBB makes a profit if the selling price of the coffee, the revenue, is greater than the expenses incurred in providing the coffee to the customer. But just as making the coffee is a multifaceted art, there are multiple factors involved in understanding revenues and expenses. On the expense side, we need to consider all the different things that go into making a cup of coffee, not just the ingredients, but also the labour, the equipment, utilities, the list goes on. Even the selling price can be complicated. What if the customer bought the coffee as part of a coffee and donut package? What if they use the prepaid punch card that BBB sells to give a regular customer a discount for bulk buying? All these considerations just to understand if BBB made a profit on a single cup of coffee. How much more challenging does it get when we think of the many cups Barry sells? Indeed, how many cups must he sell to cover all of BBB's costs and to provide some return to him as the owner? Scale this up from BBB to a multinational corporation and it's clear accounting isn't so straightforward. Accountants help organisations of all shapes and sizes answer questions fundamental to their activities. Questions like, how much does a product or service cost to deliver? How efficient and effective is the entity? Where in the entity is value created? By whom? How much is the entity worth? By now you may be asking, what's an entity? An entity could be anything from a sole trader like Barry the barista or a multinational corporation. Accounting reports on the economic activities of an entity to enable decision making by stakeholders that interact with the entity. Consequently, one key question here is, can we rely on accounting reports? In technical terms, we ask, is it a faithful representation of the economic activities of the entity? This concept of faithful representation we'll visit in a later session. Enough with the technicalities! What does accounting actually do and why should we care? Fundamentally, accounting is about describing the economic activities of an entity. Why? To enable decisions to be made. Accounting can inform Barry about how to price a cup of coffee to make a profit. It can tell him who amongst his staff is the best at selling coffee, and even more fundamentally, whether his dream business is a success or whether he's burning through more money than coffee beans. Accounting describes the many resource exchanges: selling coffee to a customer for cash, or Barry buying coffee beans on credit from a supplier, the stock of resources controlled, such as the supply of coffee beans, or Barry's beloved coffee machine, the claims against those resources, such as the loan Barry took out from the bank to start the business, and finally, the resource transformations, such as converting coffee beans, water, electricity, human labour, and the like, into a steaming cup of caffeinated bliss. Business is about buying, selling, transforming and managing economic resources to deliver value. Accounting provides a picture of all these different activities and the interactions an entity has with a broad range of different stakeholders. It reports on the resources that flow into the business. It reports on the resources flowing out of the business. It reports on the resources controlled by the business and the claims against those resources. Here we see a glimpse of the complexity which accounting has to describe and report on. We also see one of the fundamental ideas in accounting, duality. Every economic exchange has an inflow and an outflow, and a change in resources controlled or claims against those resources. Describing all these resource flows and exchanges, the stock of resources, the claims against resources, and all the interactions with the different stakeholders is difficult. It requires judgment. Accounting is full of judgment. Accountants have to decide what stocks and flows to describe. That's called recognition. They have to decide what value to assign to the stocks and flows. That's measurement. With so many different stocks and flows, accountants have to aggregate and classify the stocks and flows to enable meaningful interpretation. Even the choice about what to report is not straightforward. Disclosure judgments have to weigh up providing information that is useful to stakeholders, while not revealing so much information that, for example, a competitor can take unfair advantage. Finally, with all these judgments, we have the possibility of error and bias creeping in. So we need assurance. Judgments by experts as to whether we can rely on the reported information. To conclude, we have our conceptual roadmap of accounting. We can see that accounting is about describing the economic activities and environment of an entity over time. It requires recognition and measurement judgments to be made to record the descriptions in the accounting system. The accounting system provides a means for classifying and aggregating those descriptions to ultimately disclose in reports to both internal and external stakeholders. Disclosures to internal stakeholders is the domain of management accounting. Disclosures to external stakeholders is the domain of financial accounting. Both types of accounting enable stakeholders to make decisions and take actions that will affect the economic future of the entity. Of course, given that such decisions have economic consequences, we have auditors who provide assurance about the reasonableness of the judgments that underlie the reported information. This is how accounting informs. This is why accounting matters. Accounting isn't just about memorising rules and procedures to calculate numbers. Accounting is about judgments. Judgments upon judgments to inform decisions and ultimately actions. It's about understanding the success and failure of an entity.